Good morning, Dornbush. Download 66. Dowie, do you play bingo? What's 66?
I'm not too sure. It's been a while since I played bingo, I must admit. But yeah, it'd have to be something with a cool little catchphrase, no doubt about it.
So on our Facebook page, if you know what the 66 thing is for bingo, if you can leave a comment, that'd be great because we've got no idea about bingo. Anyway, good morning, Dornbush Download 66. Andrew, Michael.
Good morning.
Getting to the point. Interesting times as always with markets. Cracking day yesterday. Really took off, and today is off the boil a little bit, but a little bit going on in your world. What did you want to cover off today, Michael?
Yeah, Andrew, I guess there's been a couple of things we've just been watching. We've got a few clients in BHP Billiton, of course, and BHP's been a core holding for a lot of investors over many years. And looking at some of the numbers for BHP at 10-year lows at the moment, Andrew, believe it or not. So actually worse now than during the heart of the GFC. So look, those mining companies and BHP, has got a lot of specific issues going on at the moment. The Brazil, the San Marco incident. Mining companies, of course, generally on the nose, but BHP at 10-year lows, $18 odd. Hard to sort of fathom, I must admit. But they're obviously cheap for a reason. Markets, very unsure about the future pricing of commodities, and I saw iron ore dropping to $42 a tonne last night. And actually, the 12-month forward price for iron ore is now about $34. So the futures guys expecting that things are going to get worse there before they get better. But of course, the San Marco incident over there in Brazil. I do now see that the Brazilian government has put a civil suit on BHP and Vale, the joint venture partners there in the San Marco business. So anything could develop.
Only $7 billion. So
very nasty indeed, and a terrible incident, of course, and rightly so. Those guys have got to cough up some dollars. But these sorts of things can drag on, and the numbers tend to get bigger and bigger as time goes along. So that's obviously got the market a bit worried.
But I think, from my own personal point of view, you talk about being a core portfolio holding. Even if they halved the dividend, so the dividend went back to 4% fully franked. When was the last time you saw a 4% fully franked dividend for BHP? That would be never. So, I'm of the view that if you're a core long-term holder, you're happy to bottom draw it. They are not going to go broke. I would be inclined to be buying some more bottom drawing it. But as you say, there are plenty of shorter-term issues. So you've got to be prepared that it could go lower, without a doubt. And I think some of the more pessimistic people out there are saying like $14.
Yes.
So, I'm personally not in that camp, but you could certainly see that if more bad news was to come out, commodity prices were to come off some more, it won't be starting with a 2 anytime soon. But as we've also seen, when people are feeling super euphoric, they were paying $47, $48 for them, and, they couldn't help themselves. So it's interesting, at $18, everyone's running a mile. So again, you think about our successful longer-term investors, our 15, 20 years, they're just incrementally building up these good quality ones while everyone hates them, understanding why everyone hates them, but taking that really long-term view. You've got a client with, 55,000 and 9 of them?
Yes, that's right. And it's always a good point, isn't it, Andrew? When it always feels like the worst possible time to be buying it, it's usually the best time to be doing it. But again, it's this objective versus the subjective side of the brain, battling with each other. But I think you did right. Andrew McKenzie came out at the AGM the other day saying, balance sheet strength is now imperative for management. And if that does mean that the dividend is reduced, look, I don't think that that's a bad thing, really. And as you say, BHP, even with a 4% yield, is still well above that long-term average sort of dividend yield on BHP.
So that's a good. Talking about other ones that have been beaten up, Slater and Gordon. It's had a fascinating, if I can put it so politely, run.
Crikey Moses. I could probably throw in another couple of adjectives there, but
family friendly. I
remember about 6 months or so ago we were talking about Slater and Gordon and how it was sort of coming up on the buy radar, and luckily the caveat we put in was that the Quindle buy, sort of went to plan, and it didn't. numerous issues have developed there. The professional service division accounting policy was put under scrutiny. Quindle themselves have been put under enormous legal scrutiny. Slater and Gordon have had their own accounting policy issues, and even just more recently, the UK government is looking at clamping down on some of those soft tissue injuries due to car accidents, and whether people can sue and claim and all of that sort of thing. So, look, it's been a horror run for Slater and Gordon. Certainly not for the faint-hearted. I think they're about $1.40 at the moment.
Bearing in mind they were 59 cents last Thursday, but they were $7.86 6 months ago. They have been all over the show.
It has, and we're attaching a chart to the to this version, and yes, you'll get a sore neck by looking at the ups and downs. But again. Is this the time to be buying a few?
Would you be buying?
Oh, look, not for the faint-hearted, but look, if you're in for a bit of a punt, there might be a bit of a short-term turnaround in them. You need to be watched very closely, maybe with some stop losses put in place.
So what do you mean by that? Just for those people who don't understand what you mean. I agree with you, but very briefly, what's a stop loss?
Yeah, basically a stop loss is a predetermined price that if they get or drop below, that the shares are automatically sold. And the purpose is to avoid these major catastrophes in a share price fall, the 50-60% drops. A rule of thumb, it's not these sorts of values can be reviewed, and they do vary between investors, but say at 10%, if the share price drops by 10% from what you bought it at,
why.
It's, you can set in a stop loss, drops by 10%, it's just sold, and you then hopefully avoid, a 30, 40, 50%.
Unless they do it on the day, like a Dick Smith, where they open down 60%, your stop loss wouldn't have helped you, or Spotless today down 35%. But I think you're right, and after 18 years, I still struggle to do it, and I think any accumulator does struggle to use a stop loss, but you're quite right, from a capital preservation point of view, it really is something, especially post GFC, if we're talking about lessons learned after the GFC, and I know John Goulson's been talking a lot about that, using those stop losses are really important.
Yeah, you're dead right, Andrew. I think as an industry, generally, we're pretty ordinary at it. I think investors, Australians probably have this, she'll be right attitude, and it'll come good one day, but sometimes they don't. And
BHP will. Slater and Gordon, maybe not so.
That's exactly right. But yes, I think stop losses should certainly become part of a broad investment strategy for majority of people, particularly on that capital preservation front, which is paramount these days.
So last one, because we're running a little short on time. Macquarie Notes. We're a broker or an advisor. I don't know how you describe it. We have some of these notes for clients, and going pretty well. Do you want to maybe run through just a couple of the highlights?
Yeah, for the Macquarie Notes, another capital raise by Macquarie, $500 million. They're looking at raising. So again, one of these scenarios where they'll put in a margin, or they'll pay you an interest margin above a benchmark rate. So the benchmark rate is the 180-day bank bill rate, effectively a 6-month term deposit rate. Macquarie will pay 5.15% above that. So doing the maths, it works out to be about a 7.5% income yield. Now that does include the franking credit, so that it's a little bit complicated, but the interest rate is effectively discounted by the franking. Long story short, it works out to be about a 6.4%, 40% income yield. Yeah, so the 7.5% grossed up yield does look very attractive, and you go again, particularly in a very low interest rate environment that we have at the moment, and for the foreseeable future as well.
And we've had, I know from my own personal point of view, not that we've got a heap of it, but certainly pretty much every client has said yes to it simply by, and each client is different. I'm not suggesting from that because everyone's taking it that it suits you, but for clients who are looking for better income returns, it's certainly something you consider, but it's really important also to remember it's not term deposits and it's not cash. Like $1 might be 95 cents, it might be $1.05, or it's a $100 note, so it might be $95 or it might be $105. It will move around a little bit. But as you said, 7.51% grossed up. It's certainly one of the best paying hybrids out there at the moment. And the other thing is that it's got a dividend stopper. So if it stops paying its distributions, Macquarie has to stop paying a dividend. And in my 18 years of following Macquarie has not paid a dividend. And they convert into Macquarie shares in 8 years' time. And I think for some people that's quite attractive as well.
It is. The underlying performance of Macquarie Bank has been excellent really in the last couple of years. So, the underlying, company, Macquarie Bank itself has been, been very solid. So, no, these things do look
So if you're interested, I think we'll probably be done by the end of the week. So come and have a chat to us before they all go. Otherwise, I think that's pretty much us done for today.
Yeah, that's it, Andrew. I think, some GDP figures out today. Not too bad, actually, 2.5%.
Oh, gee, that's a lot better than we thought.
Yeah, so a bit above the projections there. But a mixed bag of results coming out. But there's been some reasonable numbers coming out, which has been good. So hopefully that leads into a reasonably good December period, which traditionally is not bad for the market. But we'll see how we go.
Go the Santa Claus rally. We'll talk about that more next week. Till then, thank you.
Thank you.